earlier this week, the president announced on Truth Social that there had been productive talks with Iran to de-escalate the situation in the region, which inferred a loosening of shipping traffic in the Strait of Hormuz, which in turn meant the potential for lower oil prices and a more positive outlook on financial markets. Now, putting to the side for a second that these productive talks may or may not have happened at all, what actually got people's attention was that just 16 minutes before this announcement, there was a huge spike in futures trading within these markets, clearly suggesting that someone on the inside knew what was about to happen and was profiting off it. Depending on the details of the trades, this mystery speculator could have made as much as $60 million within the span of 20 minutes, but perhaps this isn't surprising to you anymore. Insider trading has effectively become the expectation in Washington at this point, as everyone from senior elected officials all the way down to junior public servants consistently outperform the top hedge funds on the planet. It's not great, but, well, people have just become numb to it. These days, it's barely worth reporting on. It's obviously immoral at best and borderline treasonous at worst, but at this point, we know nothing is going to be done about it. And with everything else going on, it is easy to assume that in the grand scheme of things, this isn't actually hurting us individually as much as everything else in the economy at the moment. Most people don't really have stock investments worth worrying about, and even if they did, it's hard to see the impact this kind of cheating actually has. This disheartening indifference is part of what makes this week's lucky trade in particular so interesting. People actually cared about it, and there were probably two reasons for this. First, it was happening in a market that was clearly hurting them right now. Someone making life-changing amounts of money speculating on oil prices just inherently doesn't sit right while most people are struggling to put gas in their cars. The second was simply how brazen it was. The only reason we even know this happened at all was because, whoever they are, they made trades with hundreds of millions of dollars in notional value within the span of just 60 seconds, and they did it 15 minutes before the market-altering announcement. The point is that if this was insider trading, they didn't even have the common decency to spread their trades out over a few hours. If they did, there is a good chance we would never even know. Instead, they are literally giving us the bird with trading volume. Now, this particular example may be infuriating, but if there is some good that may come of it, it is showing that this happens all the time. The insiders are usually just a little bit better at hiding it. Looking back at a few of the key changes that have enabled what should be shameful behavior to become so blatant is the first step. But this itself also raises some much more important questions like, well, how much money has actually been made off political insider trading? And more importantly, how much is all of this actually costing you?
Now, should members of Congress be allowed to trade stock? Well, a bipartisan group of lawmakers says no.
To ban members of Congress from trading stocks, we heard from Representative Tim Burchett of Tennessee before the first hearing on this in the House in more than 3 years.
Spike in oil prices overnight really suggests that markets believe this conflict could last longer than initially expected, and there are plenty of reasons for that over the weekend in terms of escalatory rhetoric by the U.S., and we still have this restriction on the movement of oil and gas.
So, if you pay attention to a lot of market-moving announcements, you will notice that a lot of them follow a similar pattern. And once you see it, it becomes pretty hard to ignore. On Friday, the 23rd of May, the White House announced 50% tariffs on EU goods, sending panic into the markets that had already closed for the night. Then on the 25th of May, the tariffs were delayed and the language softened, resulting in a massive rebound. The indefinite suspension of Mexico tariffs were announced on a Monday morning, while a new 100% tariff on Chinese goods were announced on a Friday night. Strikes on Iran started late on Friday here in America, and the military operation in Venezuela was either late on a Friday night or early on a Saturday morning depending on what side of the country you were on. Then of course, the market rally this week was driven by the announcements about de-escalating the, ongoing situation that was first started on a Friday. All of these are also just examples from the last 12 months. The blindingly obvious pattern is that good news announcements will be made on Monday morning, right before markets open, and bad news will be buried at the end of the week after markets have already closed. Now, this isn't actually anything new, or even that partisan either. Before the 24-hour news cycle, it was simply considered good politicking to dump bad news on a Friday afternoon after newsrooms had submitted their prints and leaving enough time that it would be old news on a Monday morning. But today, as the market has become a live updated indication of national competence, for some reason, these incentives have clearly shifted in ways that are directly profitable. Every single one of the major announcements listed in this video so far came with suspicious corresponding trades, and this has only become easier for two reasons. The first is that bet-on-everything markets utilizing cryptocurrencies have made it easier to, well, bet on everything. In the past, if you had privileged knowledge about most events, it was difficult to actually turn that into a profit on financial markets. These platforms have also made these bets harder to track for those people who are important enough to be entrusted with some insider knowledge, but are not yet important enough to be above the law. The second reason is that Washington is simply creating more market-moving noise than it ever had before. Just from a financial perspective, government spending now represents a higher share of GDP in a given year than it did at the height of the Second World War. Even beyond that, while we may have become desensitized, massive stimulus measures, global trade-altering tweets, and Fed policy meetings getting hundreds of thousands of live viewers is really not normal. And more so than ever before, financial performance is very closely tied to government decisions. A study published by the International Review of Economics and Finance found that financial instability was markedly higher when Congress was in session, and it also found that this was when they did a vast majority of their trading, which was a surprise to, well, absolutely nobody. And well, yeah. The third reason is probably exactly what you already were thinking, which is that even for the individuals who have been identified as clearly abusing their positions for personal profit, the punishments have been very light, both from a legal perspective and in terms of how much it affects their chances of re-election. Again, people have become so numb to this that for a lot of outlets, it's barely worth reporting on. In fact, I will admit that I almost fell into the same trap. When this market activity started gaining attention, I almost brushed it off as simply being business as usual. But then something changed. People actually gave a shit. The attention this particularly egregious insider trade is getting is a great excuse to shine a spotlight on the wider problem to show just how much these games are making for the people that play them, and to work out how much this is all costing you. So it's time to learn how many works to find out why aren't they even trying to hide it anymore. This video is sponsored by Odoo. If you're running a business and you're still managing your sales in one app, your inventory in another, and your accounting somewhere else entirely, you're basically running 3 businesses at once and none of them are talking to each other. Odoo brings all of that into one platform. Your CRM, accounting, sales, inventory, manufacturing, marketing, all sharing the same data automatically so nothing falls through the cracks. When a sale comes in, Odoo doesn't just log it. It reserves your stock, schedules production, generates the invoice, and updates your books without you having to manually bridge the gap between 5 different tools. It tracks your inventory in real time and sends you automated purchase suggestions before you run low, so you're never scrambling to restock at the worst possible moment. And the best part is you only install the apps you actually need. So whether you're a one-person operation or managing a full team, you can start lean and scale up as your business grows. You can try the full platform free for 15 days with no credit card required, or use any single app free forever when you sign up using the link in the description. Alright, so one of the reasons why people may be so ambivalent about things like congressional stock trading is because it doesn't clearly impact them. A vast majority of shares in other financial assets in our economy are already owned by already very wealthy households, large institutions, or foreign investors. The kind of front-running, insider trading that has allowed Congress to effectively double the return of the stock market might be a zero-sum game. But the indirect losses the market bears to fund their gains are spread out over a lot of people who probably won't feel it in the grand scheme of things. Now, this is not to excuse this behavior, but instead it is to show why it's become so easy to ignore. But just tracking the data, or at least the data we are actually allowed to see, by going back through Stock Act disclosures can give us some really interesting insights. The first and perhaps most important point in this data is that active traders in Congress, as in people who are frequently buying and selling assets or using complex financial instruments like derivatives, are in the minority. At least from the official disclosures, most House reps and senators largely have buy and hold portfolios with the occasional trade here and there that wouldn't really be considered outside the ordinary for most relatively wealthy career professionals. Now, that might sound like I'm devil's advocating a bit here, but it's actually the opposite. It instead shows that the outperformance in congressional stock trades are largely driven by a small group of extremely active traders. In fact, most of these elected officials actually did worse than the market as a whole. According to the data that has been disclosed from 2025, just under a third of congressional portfolios outperformed the S&P 500. But that was the same year where Congress as a whole was up over 20% above the already strong returns of the broad market. In plain English, what this means is that there are a few dozen elected officials who are making absolute bank and pulling up the average considerably. Congress as a whole on average is now making over 10,000 trades a year, largely concentrated amongst just a handful of people. The median number of trades made by a congressperson was just 3, raising the question of how these other people have time to do anything else. Now, I know this goes against the narrative that all of them are in on it, but that's actually a good thing. It shows that people who are clearly gaming the system are a minority, and that we can actually hold these officials to a higher standard. But before you get too optimistic, remember this is still a how money works video. So the second thing we found when we compiled this data is who those Congress members making all of this money actually were. The reality is that it was largely more senior Congress people who were sitting on lots of committees. And almost every year since these disclosures were introduced, the party that has controlled the House outperformed the party that was in the minority on their stock trades. These special committees give them access to even more information than they would get as regular lawmakers, letting people like Nancy Pelosi trade Nvidia while shaping the CHIPS Act, or Tommy Tuberville dabble in corn futures while serving on the Agricultural Committee. Now, mercifully, much smarter people than me at the National Bureau of Economic Research actually found the same trend to corroborate these findings. The study revealed that lawmakers generally perform similar to their peers until they are put into a leadership role, at which point they outperform their peers by 47 percentage points on average, which in the world of investing is an unfathomably large gap. In 2025, these insiders again considerably outperformed the market and their peers in Congress. The only people from this group to actually lose money were Chip Roy, who got absolutely hammered on a single energy stock and has since become a major advocate of limiting congressional stock trading, and Mitch McConnell, who reported a net trading loss of 1.8% in the year. And that is probably the closest I will ever get to defending Mitch McConnell. Oh yeah. And the third thing we found out when pouring through this data is that even though it is technically publicly available, they have made it about as difficult as humanly possible to find. The user interface that you need to use in order to find disclosures looks like it was straight out of the 1990s, and the information is presented very unintuitively. Throw on some low poly GIFs and you can almost hear the dial-up tone. Again, for a law passed in 2012. Now thankfully, if you don't feel like subjecting yourself to this, you can also find a lot of this information on third-party websites that track this data as well. So I will leave a link to that below. Unfortunately, the reason that there are so many third-party tools that track this data so closely is because, well, people just try to make money by copying the trades of their elected officials, which is not great, but at least it gives us some user-friendly transparency. Finally, of course, the Stock Act only applied to members of Congress and their staff. It doesn't include the president, cabinet members, or other high-ranking officials. And it certainly doesn't include the off-the-book transactions like the one that inspired this video in the first place. But even still, from what we know, how much is all of this actually costing us? Well, collectively, from what has been legally disclosed, Congress specifically only does about $1 billion worth of trading volume in a single year, which is clearly an insane amount of money for a totally random representative cross-section of our country. But it's also not enough to meaningfully move markets by itself. The real cost, of course, is how these financial incentives alter their decision-making. Is someone on the Agricultural Committee going to propose policy that helps farmers but hurts their corn futures? Will someone who owns millions of dollars worth of Nvidia bail out the AI industry? And is it worth undermining trust in our geopolitical channels to make a few $1 million on oil futures? These decisions impact how much we pay in interest, the validity of our trade deals, and the strength of our currency. Our economic uncertainty index is now higher than it has been at any point outside of the pandemic, which just on our debt alone means we need to offer higher interest rates to offset the increased risk that now comes with lending to America. This has more than doubled our interest repayments over the past 5 years alone, something that we are all eventually going to pay through higher taxes, higher inflation, or just good old-fashioned economic default. Again, this is also just one avenue where this political self-serving is coming back to bite us. Is insider trading exclusively responsible for our debt risk premium? Of course not, but it does mean that there are direct financial incentives not to fix it. But if you want to know how much worse this particular problem can get, go watch this video next to find out why we haven't had a debt crisis. Yet. And don't forget to like and subscribe to keep on learning how money works.